and welcome to Market Domination. I'm Allie Canal, live from our New York City headquarters. Only an hour left until the closing bell, and stocks are rallying as investors price in a September rate cut, encouraged by a better-than-feared inflation report, even as core prices hit a 6-month high. Still, some economists are warning that the Fed's job just got harder as July's stubborn core reading, combined with tariff-driven pricing pressures, complicate the path forward for monetary policy.
This is a meaningful increase in inflation. This is going to require a reconciliation of the Fed's dual mandate. This is not the easy layup that many market players and investors are portraying in terms of Fed rate cuts. And this is going to, I think, lead to a certain reassessment of those Fed rate cut probabilities.
Let's welcome in Robinhood Chief Investment Officer Stephanie Gilge, who will be joining us throughout today's show, along with the Data and Markets Editor Jared Blickery. Jared, let's start with you on these equity moves because we're on track for a record close on the back of that inflation print.
Yes, we are. In the S&P 500, the NASDAQ Composite, and the NASDAQ 100, record closes are in tow here. In the Dow, which we're looking at right here, that is up 1% right now. We're 442 points. You can see we rocketed higher on the open, and we have just maintained these highs throughout the day. And the other charts are going to look fairly similar here. S&P 500, a little bit more upward sloping. But I want to show you what's happening with the Russell 2000. That is up 2 2/3%. This is the best day we've seen in the small cap index in 3 months. You'd have to go back to May 12th for that. Also, a very similar stat in the transports, and we'll take a look at the Dow transports in a minute. First, I want to show you what's happening in the bond market. We have the long end of the curve, the 30-year T-bond yield. That is up 4 basis points to 4.88%. The 10-year up as well, just about half of that, 2 basis points. And the 13-week T-bill, that initially took a tumble about a basis point lower. This is very closely tied to what the Fed is doing in their overnight markets, and so that's why I look at the short-term rates as well. Gold did not move that much. If this is in fact an inflationary report, we were talking with Joe Bruce Willis earlier this morning. We were just watching him. We are not seeing it reflected in gold prices right now. Now I want to take a look at the sectors as well. Everything you can see here is in the green. Those that are doing the worst here, or the least well, those are the defensive ones. So staples, real estate, utilities, and healthcare. What is working the best here is communication services. That's where you're going to find Meta and Alphabet, as well as tech. That's XLK, materials, and financials. So the cyclical sectors are all outperforming here, at least a lot of them are. And you can really see this reflected in the NASDAQ 100, and especially the Mag 7 here. And this is a much different picture than we were looking at just yesterday. NVIDIA up 0.5%, Microsoft and Alphabet up about 1.5%, Meta up 3%, Broadcom up 2.5%. So a lot of bullishness in not only the semiconductors, but also software. I'm going to show you the Dow here, and we see a little bit more red on this board. As I said, staples were pulling up the rear, still in the green as a sector, but Walmart here is down 1/3%. And I'll just leave here on the transports. This is also very different than what we were seeing a day ago. Transports surging as well.
Jared, a sea of green here, all sectors in the green. And Stephanie, I want to get your reaction to this sharp bounce that we're seeing today, especially considering we did see those core prices hit a 6-month high.
I mean, I think the market is telling you that this inflation print is better than expected, or cooler than expected is really what I am seeing. On the tariff front, it was mixed, right? If you look at like some of the goods inflation, it was mixed. Services inflation was a bit higher, but some of this is around like dental inflation is the highest that it's been in its history. These are things that I think the market as a whole is not so worried about. And so it's saying, oh, at the very least, we don't have to worry about rising inflation, and thus the Fed can cut. And I think that's really what this comes down to.
All right, Steph, stick around. And Jared, thank you so much. We'll be back with you later on in the show. But now I want to bring in Michael Gapin, Morgan Stanley chief U.S. economist. So, Michael, we were just discussing the equity reaction to this July CPI print. Investors seem to be hanging their hat on the fact that price increases weren't as concerning as some forecasts had suggested. But we are seeing clear signs that certain categories, especially footwear, household furnishings, they're rising on the heels of these tariffs. And the expectation is that things will get worse. So really something for both the inflation pessimists along with the optimists here. Which camp do you sit in?
That's a very good way to characterize it, because the good news here, as you say, is that tariff impulse into inflation wasn't as high as anticipated this month. So a little breather on apparel and new cars in particular. I do think it suggests that maybe instead of getting a rapid pass-through into inflation, maybe the risk here is we just get an elongated one. It may be that new car prices move higher later this year as new models come in and inventories get drawn down. We'll have to see. But that was the good news. The bad news, as you pointed out, is that services inflation was pretty soft in prior months, and it did give the impression to many that, hey, maybe we could ignore tariff inflation because services weakness will offset it. But now I think a lot of that's reversed. So I'm not ready to say, oh, services is about ready to roar higher. You're right that it was in some kind of modest categories and maybe non-traditional services categories. But services inflation at 64% of inflation, it does tend to be stickier. And if it's firming, we do have to watch out. So some good news in this report and some bad news.
Good news and bad news. Now, you are still calling for no rate cuts in 2025, but markets are pricing in almost 100% certainty that the Fed cuts rates. So what are markets getting wrong here?
Well, I think that the debate here really comes down to how much the Fed values the unemployment rate as the right summary statistic of the labor market, or how much it hangs its hat on softness in payroll. So I think most everyone on the committee would say, yeah, inflation's further from our 2% target than the labor market is right now. But if payroll growth is slowing, maybe we should do some risk management here. In our view, we would say there's enough inflation momentum here that suggests inflation will continue to deviate from the Fed's mandate. But look, we're basically down to one employment report and one other inflation report that the Fed will receive during blackout. So they may just take comfort from the signal and cut in September. But in our view, immigration controls are likely to keep the unemployment rate low, and that means a tight labor market. And that's why we think the Fed should or will remain on the sideline for the rest of the year.
Mm-hmm. And with that immigration story, keeping the unemployment rate low, you've said yourself that would be an artificial unemployment rate, right? That it wouldn't actually be at that level. So how do you really parse through the tea leaves there when you look at the labor side of the equation, especially considering all those downward revisions that we just received?
Well, I do think it would be a real unemployment rate, in the sense that if immigration controls are dramatically reducing growth in the labor force. So labor supply is falling about in line with softer labor demand. And so the unemployment rate is low and the labor market is tight that way. But the two-speed component of the labor market is if employment growth is slowing, at some point the Fed tends to get worried about that. So, Powell said, look at the unemployment rate. That's the best summary statistic. But others on the committee are obviously saying, OK, fine. But payroll growth downshifted a lot more than I thought. So again, should we take out a little bit of insurance here and offset labor market weakness?
And given those revisions that we saw, the controversial BLS pick from President Trump, are you concerned about the sanctity of the data and how we should be interpreting that data moving forward?
Well, I would agree with the notion that, we have had large revisions over the last 5 years or so. It's not unusual given the massive shifts in the economy and the relative shifts in demand that we saw in the pandemic and coming out of the pandemic. So larger than normal revisions, I think, are to be expected, but some revisiting of the techniques is probably warranted. But what doesn't make sense to me are headlines that say, well, maybe we'll just stop publishing the employment report, or the answer is to cut government funding and cut government staff. If you're going to reevaluate the procedures and come up with better ones, that typically involves some reallocated spending and some greater workflow. So I agree that the statistics need to be accurate and timely and reflect what's going on. So the challenge is, how do we get there? If we don't, confidence in the data will weaken, and you could see a kind of another risk premium emerging in financial markets.
Does this bring you more concern when it comes to Fed independence, which really has been a topic of conversation throughout the entire year?
So if independence, and that the Fed would not have the right data to make the right decisions, or are you just saying with the nomination of a new Fed chair, how much that committee would skew to lowering rates anyway?
I would say both, Michael, right? I feel like these are both risks here that investors are trying to determine whether or not they are sizable enough to really start to impact the markets.
Yeah, I mean, let's just take data quality in the sense of if you believe it means at least volatility in the data is different, so the value of any one data point is reduced, then the Fed needs more time to decide what the right course of policy is. That means the Fed in general could move later than it needs to, right? So you need that data to be clear and communicate to policymakers what we should do. Any lack of clarity likely means it takes longer to figure that out. And I would just say, it'll depend on who the new Fed chair is and will depend on where economic conditions are. If the market's right, most forecasters are right, the Fed will be cutting by the time that new chair comes in anyway. So maybe it's more about the trough of the cutting cycle than it is the start. And we certainly have sympathy for the idea that when the Fed cuts, they may end up cutting more.
All right, Michael, I'm putting you in the hot seat here. If you're the Fed, pick your poison. Cut now while core services is firming up a bit, core goods potentially still sticky, or do you risk tighter labor market conditions when the labor side of the equation is stalling a bit?
I think it makes sense to wait a little bit longer to ensure that any inflation impulse is transitory, right? Because the risk is if you cut too soon, it could be the case that the tariff drag on activity wanes, fiscal policy comes into play next year, and growth rebounds more strongly, and therefore inflation kind of settles in and gets stuck somewhere in the high 2s or around 3%. So I think to avoid that outcome, it makes sense to wait a little longer, get clarity on inflation, and then understand that now the right thing to do is to cut.
Mm-hmm. And what data point would maybe change your thesis of no cuts this year? What are you looking for to really make you think perhaps a cut is warranted?
Well, we still have PPI data and import prices to translate today's CPI report into PCE. So maybe we get additional weak readings on import and producer prices, and that core PCE number later this month is softer. That would be one. Another is we get an August employment report that gets downward revisions to July, like reinforces that signal about weak payroll growth. That would likely be enough too. So I think another way to say it is today's report on inflation had some good parts, some bad parts. Wasn't obvious that it should tell the Fed maybe not to cut. So it raises the bar for that August employment report, meaning it has to be a pretty strong report to keep the Fed on the sideline.
Bringing it full circle for us. Michael Gabin, always a pleasure speaking with you. Thanks so much.
Thank you.
Stephanie, I want to continue the conversation with you here. What's your reaction to some of those points that Michael Gabin was just raising and the fact that he is calling for no rate cuts this year?
Yeah, I see his points, but I'm sort of in the place where I think like the labor market has sort of spent. I agree that it's sort of we're at full employment for what's possible. But I do think that the Fed will end up having, and he mentioned the word insurance, and that's where kind of I am at. I think there'll end up being insurance cuts. I just think there will be, because we also have, if you look at like the CPI data, you're hearing a lot through earnings that like companies are able to overcome the tariffs, and you can make a strong argument that tariffs are not necessarily long-term hits to inflation, but short-term hits to inflation. And if you have an environment where the labor market is slowing, but not necessarily bad, then you can put in these so-called insurance cuts to make sure that we don't head into a very slow growth environment.
Mm-hmm. How do you think the market would react if that September meeting comes and we do not see a rate cut?
I think there'll be a sell-off because I think that, I mean, you look today's CME futures, Fedwatch,
100% basically.
Yeah, and we have prediction markets as well on this, and they've all kind of moved up to even the possibility of 3 cuts this year, which I don't see.
So how should you play the markets? Given a lot of this choppiness, we have Jackson Hole coming up later this month, usually a lot of volatility there. Should you be getting more defensive? What are you advising folks?
Yes, we see 2 things. We see an environment that valuations are better in the more cyclical areas and should benefit from an environment that is kind of perfectly balancing the possibility of inflation with the possibility of slowing growth and kind of seeing this like good economic environment in general. But I do think that the markets have, like, there is no room for error. And if you do have an environment or some sort of data point that comes out that is against like where the traffic is heading, then I think you're going to end up having a bit of a sell-off. You also have the budget debates coming in the House and the Senate, and that can be important for liquidity in the markets, and that's often can happen at a time like in September when the Fed is in their quiet period, companies are in their quiet period because they're getting ready to start reporting. And then when in that absence of any data to offset, you can often, that's why September ends up being like not a great month, historically speaking.
And when you look across the stock market right now, it feels like a lot of the gains are being driven by things outside of the macroeconomic landscape, like AI, for example. Do markets care as much about policy as they have in the past?
It's a good question. I think they do in the fact that policy is shifted greatly this year, and policy is toward technological innovations, rewarding funding, building in this country, and also defense spending. So if you're looking at some of those areas, like those are benefiting. You've had healthcare that haven't been benefiting, and particularly in like managed care and places that are sort of against where the government has been focusing their time. So I actually think policy almost matters more, but it's not necessarily Fed policy as much as it is fiscal policy.
Interesting. We'll be talking about that more. So Stephanie, stick with us. And now I want to turn over to our own Jennifer Schomburger, because on the back of new inflation data, hawkish Fed voices are emerging. Kansas City Fed President Jeff Schmidt said increased tariffs appear to be having only a limited impact on inflation, but that's reason to keep policy on hold, not to ease. The Trump administration, meanwhile, warning that the Fed could risk damaging the economy. So let's bring in Jen Schomburger. She's our Fed correspondent down in Washington, D.C. Jen, what's the latest here? What are you hearing?
Hey there, Allie. Yeah, that's right. I spoke with Joe Lavorgna, counsel to Treasury Secretary Scott Bessent earlier this afternoon. And in response to some of those hawkish voices on the Fed, he said those members of the Fed who are waiting to see the data come in to see what the impact of tariffs are on inflation, that, quote, Fed policymakers need to be forward-looking because inflation is lagging and monetary policy itself works with long and variable leads. The risk is that you just have a much weaker economic outlook because your policy is too tight. Lavorgna noted that core goods prices are up just 0.8% since the tariffs were implemented back in February, and that headline inflation measured by CPI has been soft over the past 3 months. Lavorgna also pointed to prices of new cars, which are highly sensitive to tariffs given the parts and materials that have to be imported, which he says are down 1.3% since February. And in the wake of these inflation numbers, President Donald Trump again calling on Fed Chair Powell to lower rates, saying that consumers are not paying the price for higher tariffs, that those are being absorbed by companies and foreign governments. Trump posting on Truth Social this morning that, quote, Jerome, too late, Powell must now lower the rate. The damage he has done by always being too late is incalculable. Fortunately, the economy is so good that we've blown through Powell and the complacent board. The president said he is also considering moving forward with a lawsuit against Fed Chair Powell because, quote, of the horrible and grossly incompetent job he has done in managing the construction of the Fed buildings. The president there referring to the construction of the Federal Reserve's headquarters here in Washington, which are over budget. The markets, for their part, seem to be siding with the administration and the president, pricing in a better than 94% chance that the Fed cuts rates in September. Of course, Allie, a lot of data between now and September.
A lot of data, and we've really been seeing a lot of news. And to that point, Jen, on Trump's BLS head appointee, we're learning more and more about his pick. What can you tell us?
Yeah, that's right. I also spoke with Lavorgna about what we could expect from President Trump's nominee for BLS Commissioner E.J. Antoni. And he says that he expects him to take a holistic approach to gathering data. He says he's going to be looking at checking on whether those seasonal adjustments to the data as well as net birth and death adjustments are correct. How is the sample size? Is the sample data good data? He's also going to be looking at whether they could make use of real-time tax collections or other technology tools that were not available when these surveys were developed decades ago. Lavorgna also says he really hopes that Antoni holds press conferences in the name of transparency to really elaborate and help the public and press understand the data.
All right, Jen, keeping the pulse for us down in D.C. Thank you. Appreciate it. We're just getting started here on Market Domination. Coming up, President Trump may be walking back his tough talk to Intel CEO. We'll explain why. Plus, Circle reports earnings, and we're talking directly to the CEO about the company's performance. And Big Bear stock is sinking. We'll explain why when we return. Stay with us. Now time for some of today's trending tickers. We are watching shares of On Holdings, Intel, and Big Bear AI. Starting with On Holdings, parent of On Running. The Swiss sneaker brand posted a quarterly loss, but shares still moved higher after the company raised its full-year guidance, even as tariffs pose a potential headwind. On Running CEO and CFO Martin Hoffman spoke to Yahoo Finance's Julie Hyman earlier about the decision to boost its outlook. Take a listen.
I think this is where the power of On being a premium brand is most visible. This really allows us to drive a premium customer experience, to grow our D2C channel, to have more meaningful connections with our customers. But then also the innovation that we have in our products allows us to launch products at higher price points, and that is driving a superior margin profile.
Now, Steph, if we looked at the CPI report this morning, we did see footwear prices rise 1.4% month over month, but On Running really confident in that business model. They also saw better than expected sales, which was a relief heading into this report because analysts, they feared that momentum was slowing down a bit, especially in a market like shoes and footwear that's very competitive.
Yeah, I mean, I think also this company got caught up in the whole, just worrisome about the tariffs. The stock itself is down a lot year to date, if you look at it. So I do think this is also a game. I say expectations are always everything, and expectations were pretty low, I think, heading into this. I do think it was interesting from their earnings report or during their conference call, they said, we've dealt with tariffs before. They were 20%. Now they're going to close to 40%, but we've already raised our prices, they said, as of July in the US, and they have other levers they can pull, and that's why they were so confident in the future, which was interesting, I think, to hear, especially on the day that we get CPI as well.
Yes, and we're seeing shares up 9%, but to your point, even with those gains, we're still down 9% since the start of the year, and they're really targeting Gen Z as well. So we'll see what can come from that. But another stock that's on the upswing today is Intel. President Trump flip-flopping on CEO Luc Patan after holding a meeting with him in the Oval Office. The president says their meeting was, quote, very interesting, and that Intel will present ideas to the administration on bolstering U.S. tech and manufacturing leadership. This comes just a few days after Trump posted on Truth Social that Patan should resign immediately, calling him highly conflicted due to alleged ties with China here. Now, we've seen tech CEOs really buddy up to President Trump. You can just look at Apple. That stock was on a downward swing, and then we have Tim Cook meeting with Trump, and we saw a rise in those shares after that $100 billion commitment into U.S. investment. So it seems like no matter what tech company you are, if you want to get ahead here, you need to at least have conversations with this administration, and you'll be rewarded in your
think
stock.
You need to show commitment to the U.S. And I think the CEO of Intel is very aware of probably what he has to navigate. I mean, he has a great track record at his previous place at Cadence Design Systems. That stock had more than doubled the S&P over the time period that he was CEO. And I think he knows he has a good idea of what he wants to do. But look, 25% of their business is in China, so he does have to be balanced in his approach. But certainly, I wouldn't be surprised if there was some announcement of an investment coming out of the meeting.
Yeah, and Intel really in the midst of this aggressive turnaround plan. We're seeing a nice 5% pop today, and year to date we are up 8%. So maybe we can get back to those former glory days. Probably not, considering where we are with this landscape.
They're well behind some other competitors. So
exactly. Great point here. And then finally, another stock I want to talk is Big Bear AI. That's under pressure after posting earnings that missed the mark and cutting its revenue guidance from prior forecasts. Second quarter revenue came in $8 million below estimates and was down $7 million from a year ago. The company also reported a loss of 71 cents a share, far wider than the expected 6-cent loss. The weak results follow C3 AI's preliminary preliminary numbers last week, which missed revenue guidance by 33%. Now, a lot of the shortfalls in this report did come from disruptions in federal contracts that was a result of DOGE, a lot of those government efficiencies. So analysts still seem optimistic on shares over the long term. Cantor Fitzgerald, for example, reiterated its overrate rating, raised its price target from $5 to $6 a share, and said the report reflects secular tailwinds ahead. But, we'll have to see where this company lands.
I think you have to see, like you said, it's a trend, right? Because of C3 AI last week. And I also think they are competing against Palantirs of the world in terms of contracts, and I do think that it can be tough to play with the big boys. And so I just wonder, does this end up being like a target in some way, shape, or form? And that's why there's some still positive view on the stock. But I just think it's a tough place to play when you do also need so much capital to keep going, as we've seen from a lot of the tech companies in the space.
And shares are up around 34% since the start of the year.
Expectations are already high.
Exactly. But some of those near-term execution issues really affecting the quarter here. Well, fintech group Circle reporting quarterly earnings that beat expectations. The first earnings report for Circle as a publicly traded company. Yahoo Finance's Julie Hyman spoke to Circle CEO Jerome to talk about the company's better than expected quarter and the company's stablecoin.
Technology companies, large corporations that want to use this infrastructure is really growing, and we're seeing that demand coming in.
So it sounds like the shorter answer is everywhere and from everyone in some ways, Jeremy. I am curious if you can tell me more about those cross-border transactions, how it's being used in emerging markets. Do you have an idea of sort of the percentage of transactions that are being done overseas versus in the U.S., for example?
Well, we believe, and we have very good data, that a material majority of transactions are non-U.S. There's actually a lot of activity out of Europe, but there's also significant activity in emerging and developing markets ranging from Latin America to Africa to Middle East to Southeast Asia, and sort of the Asia market as a whole is a significant one. And while we don't sort of see every transaction in terms of the counterparties, what we do see are sort of trends in flows. And so you're seeing flows that are through really powerful corridors, whether it's Latin America to Asia, suppliers and buyers, Middle East and Africa, which again is common kind of corridors in economic activity. So we see that, and it's one of the reasons why we built Circle Payments Network and launched CPN in Q2, is building a sort of application layer that financial institutions can use to more efficiently do international money movement and cross-border settlements using stablecoins as the settlement mechanism. And we went live with 4 corridors during the quarter: Hong Kong, Nigeria, Brazil, and Mexico. And through the remainder of the year, we're going to keep adding more and more corridors that allow financial institutions to take advantage of the speed, the efficiency, and the programmability of moving money on these networks.
Jeremy, you've offered these new services. You're collecting some fee income from some of them, but the vast majority of your revenue still comes from gathering interest on stablecoin reserves. What happens if and when the Fed cuts interest rates, whether it happens in September or beyond that? Does that then cut down on your revenue, on your interest revenue?
Yeah, I think there's a few key things to think about here. The first is that as expectations of rate declines came, and then as actual rates declined over the last year, we've seen significant growth in USDC. And so we've observed historically a kind of inverse correlation there. And so that 90% year-over-year growth is very significant and has actually contributed, even though you've seen a decline in the rate environment, it's actually contributed to an increase in revenues. And in fact, we saw our adjusted EBITDA grow 52% year on year with an adjusted EBITDA margin of 50%. So there are multiple dynamics at play. And in fact, we believe that lower interest rates are going to be accelerative to the business as money velocity picks up, as invested capital picks up, and as more people are putting money to use in the economy. This very high utility form of money will grow, which leads to the second point, which is there are a lot of perspectives on just the technology utility of this driving growth. And there are estimates ranging from the Treasury Department saying this will be $2 trillion by 2028 to bank analysts saying this could be $3.5 trillion by 2030. And so the utility and network effects of this technology are also a source of growth. And so what one has to really look at is step back and look at, what kind of growth is going to come from the establishment of these stablecoin networks and the velocity of money on these networks. And then obviously back to your core question, we are building new products and services. We're adding major new features to our existing products and services that allow us to generate new income streams, subscription and services fees, transaction fees, and that collection of revenue actually grew 250% year on year, and we expect to continue to grow that. And so that is also margin uplift. We saw 200 basis points of margin uplift from these new higher margin revenue streams. And so over the long run, we expect to be able to grow the money stock on the network, grow the scale of the network, and grow these other services and revenue streams. And that gives us, a belief that this can be an even more profitable company over the long run on an adjusted EBITDA basis.
After the break, we take a look at fixed income after today's consumer price index results. We'll be right back. Wall Street is pricing in a 94% chance of a 25 basis point rate cut in September after July CPI came in better than expected, albeit with an increase to the core reading. My next guest agrees with that assessment and says the Fed is likely more worried about a slowdown in the labor market versus an uptick in inflation. Joining me now is Kelsey Barrow, JP Morgan Asset Management Fixed Income Portfolio Manager. So Kelsey, like we just said, you're in that camp of 25 basis point cuts, and you say it's a similar environment to one we saw 1 year ago, maybe a little bit different. So set the scene for us. What's similar, what's different, and what are the lessons learned?
Right. So if we compare ourselves to September of last year, the Fed was right about to cut 50 basis points and to cut 100 basis points by the end of the year. That brought us from 5 3/8 to 4 3/8 today on the Fed funds rate. Now, where are we? Well, if you just look at the deceleration in payrolls growth in the last 3 months, it would suggest that the Fed should absolutely be cutting rates again. So the 3-month moving average on payrolls growth is at 35,000. The 6-month moving average is at 80,000. That's about the same, if not weaker, than it was when the Fed was looking at cutting 50 basis points. But it is not the same world as it was a year ago. So what is different now? Well, one, the Fed funds rate is 100 basis points lower. So we're already at a less restrictive spot to start with. Second of all, the unemployment rate isn't moving higher. And that's the thing that Chair Powell has been emphasizing, which is that if labor demand is falling, but labor supply is also falling and the unemployment rate stays the same, it's not necessarily going to set off the same alarm bells as it did last year when the unemployment rate was rising from 3.5% to around where we are today, which is 4.2%. And then, of course, the other big difference is that while there are mixed signals about how much tariff inflation the U.S. economy is going to have to withstand, or consumers are going to have to withstand, how much is going to be passed through, we do know that in the short term, we're not likely to see a lot of further progress towards the Fed's inflation goal of 2%, at least in the short term. And that's the reason why I don't think that a 50 basis point rate cut is on the table, but we do think that the Fed is sensitive to downside risk to growth and inflation and is going to deliver that cut in September.
And when we saw that 50 basis point cut last year, there was a lot of commentary that the Fed was doing that as a catch-up move, that they were already too late. Is there anything that we can look at from that moment and apply to today? Obviously, we know President Trump continues to say that the Fed is late on rate cutting.
Well, I would say that the big difference is, one, the unemployment rate isn't rising like it was last year, and also layoffs remain extraordinarily low. So if you look at something like initial jobless claims, that has stayed very, very sticky and very, very low in this environment. And so there's been a bit of a divergence between initial and continuing claims, meaning if you've lost your job, it's quite difficult to find a new one. So the time it takes to find a new job is an indication that the labor market is softening underneath the surface. But at the same time, companies are not really on any large scale participating in layoffs. And honestly, what we hear from companies and what our corporate analysts are saying pretty much across the board is that earnings in the second quarter are coming in better than expected.
And it's interesting to track the bond market moves because we saw bonds rally on the heels of that report, but now yields are starting to creep a little bit higher again. Why do you think we're seeing that reversal, and is it all about inflation at this point?
So if I look at the initial reaction in the bond market to the CPI report this morning, it came in as expected, and what you got was a knee-jerk move lower in yields. And that's not because there wasn't inflation. There was inflation today, but the market was prepared, I think, for a little bit more inflation than potentially what we've gotten. I think more broadly, yields are in a range-bound environment, and while that may seem boring, it's actually a great thing for fixed income investors because it brings us back to the good old days of collecting carry and high starting yields. So if I think about where, for example, the US aggregate bond index started the year, the yield was around 4.8%. I look at how much the US aggregate bond index has returned year to date. It's around 4.3%. So you've gotten a little bit of carry, you've gotten a little bit of price appreciation. If we continue in this range-bound environment, you're likely to see returns for the year in a high-quality fixed income portfolio north of 5%. You know, just on a range-bound environment where spreads remain around where they are now, yields remain around where they are now, and you just collect the carry.
So how do you play that then as an investor? How do you play the fixed income space, especially considering all the potential volatility that we could see around rate cuts?
So I think the first thing, you know, in this range-bound environment is you need to stay invested. You have to be invested to be collecting those coupons. Now, in terms of the sectors that we like, we continue to see value in corporate credit and securitized credit. So securitized is another area where there's high quality spread above treasuries. So a lot of our conversation today has been about the Fed. It's been about treasury yields being range-bound. Well, there's an additional spread that you can collect looking beyond treasuries into other sectors within the fixed income market. And what we've done is we look at every credit that we put into our portfolio. And for this year, we've stress tested them for the 10 and 20% tariff environments. And we're looking at how does that hit revenue? How does that hit earnings? How does that impact the balance sheet and their ability to repay their debt? And what we found is that corporate health is extraordinarily strong right now. And so while the outlook and the direction of travel for revenues and earnings because of higher tariffs is undoubtedly a negative, for a bond investor, you know, when we're concerned about getting paid back, you know, companies still have a lot of free cash flow and a lot of ability to, you know, manage their debt loads.
All right, well, yields might be boring right now, but this is still an interesting conversation, so we're going to have to keep bringing you back here. Kelsey, thank you so much. Appreciate it.
Anytime.
President Trump's tariff policies may be having impacts on your grocery shopping, causing prices to rise as the cost of the tariffs are passed on to consumers. Yahoo Finance's Julie Hyman spoke to Stu Leonard, CEO and President Stu Leonard Jr., to ask about how grocery stores are managing tariffs.
Well, right now, the whole tariff thing is quiet. Everybody's really not reacting too much in the food industry right now because nobody knows what's going to happen with the tariffs. A lot of people brought inventory in pre-tariffs, so we're eating through some of those inventory, whether they're lobster tails or you know, any of the other products that we could buy in bulk, tequila, a lot of wines out of Europe, a lot of that stateside. So they're starting to burn through that inventory right now. The tariffs are all kicking in at a new level right now, so the retailers don't know what to do. We're in a pause mode right now. We haven't raised prices. I haven't passed on any tariff prices, even though one thing you can't buy in the United States are things like bananas, mangoes, and some tropical fruit. So our importers are eating it right now. They're not going to do that forever. So I think next month is going to be a key month to determine what the pricing is going to be like going into November, December, which is the huge event for the food industry.
Yeah, I don't know. Maybe eventually with climate change, we can grow some of those bananas in the U.S. after all. We'll see, Stu. But I do want to ask you about aluminum, because there we have seen a tariff. And I know you guys made some changes to your supply chain based on that. Can you talk to me about that?
Yeah, sure. I mean, this is just one of the aluminum pans. Everybody watching is used to seeing these at a food store. And the price of this used to be 11 cents. Okay, with the new China tariffs, this aluminum container went up to 15 cents. Okay, so our buyer, went around and found a company out in Minneapolis. I think it's Handy Foil something. And it's a family business. It's been there 80 years. And they said they would do it for 13 cents each. It's not 15, but it's 13. And they said once they can ramp up and get more volume in the U.S., they said their business is on fire right now. They might be able to get that down to 11 cents for us in the future.
Stu, what would change the calculus and lead you to start to raise prices, right? At what point, is it if you see consumers pulling back a little bit? What kind of goes into that decision-making process?
Okay, well, here's a decision that we have right now. We just got a 50% tariff, from India. They sell a lot of shrimp. Ecuador is 15%. They sell a lot of shrimp also. So one of the things is this looks like it probably with the tariffs and everything could be going up 50 cents to $1 a pound. Now we sell 500,000 pounds of shrimp a year. That's $500,000. I can't absorb all of that extra cost right there. So I'm working with our suppliers, trying to get them to split it with me. And I'll probably, if the tariff thing doesn't subside a little bit this coming month, the retailers have no choice. I mean, we're stuck a little bit. We would have to nudge prices up as little as possible, but we can't. We'd have to absorb some of it.
So there is another one that does have to do with tariffs, and that's wine and spirits that are being imported, particularly from the EU. You're the best in the business at show and tell, Stu. I got to tell you. So you are ready. You are ready, man. So is that stuff exempted for now? And if it is that an indefinite exemption?
Well, it's not exempted right now. So we are getting a 15% increase. My daughter Blake here runs the business, and things that are tricky are things like this, which is tequila. You can't buy that anywhere else in the world except Mexico. So right now we're not getting tariffed for it, but that could go up. Champagne, what I'm hoping, is that instead of paying a 15% tariff in France for champagne in the region, that people will go to sparkling wine that we produce beautifully in California. Many of the families from France came over and opened up their own vineyards in Napa Valley, Sonoma Valley. So I'm hoping we'll see more sparkling wine this year because it's non-tariff.
And then I'm also curious, Stu, we've seen beef prices go up. People migrate to chicken. Have you been seeing that in the stores as well?
Yes, definitely. I just talked to our buyer. Hey, you want the best prop of all here that we could do, Julie? Look at this.
Of course. I'm not going to say no to that.
Okay. But this is a ribeye steak here. Now, what we've noticed with our customers is they're not sacrificing quality. They are more conscious about price. Customer count's been brisk right here. We notice everybody's a little more hesitant about throwing that one extra thing in their basket. But people are switching right now. Meat prices are at a historic herd size. It's the lowest it's ever been in like 50 or 60 years. There's a lot of droughts out west. It's expensive to feed these animals. So a lot of our ranchers have decided not to invest in new cattle. So there's a low herd size, but people still want a great steak. So it's putting pressure on beef prices. Then again, you might see like 50 cents, maybe $1 a pound on some of your nice center cut steaks, porterhouse, ribeyes, and New York strips and things like that.
Coming up on Market Domination, what is the state of the meme stock trade? Stick around, that and more after the break. Bank of America is out with its most bullish fund manager survey since February, with lower probabilities of a hard landing and equity allocations on the rise. That survey records how institutional investors are feeling, but we want to talk about retail traders and how they're feeling in the stock market today. So with me is Steph Guild, Robinhood Chief Investment Officer. So Steph, when you look at some trends that on the Robinhood platform, what sticks out to you? What are you noticing?
A couple of things. One is Tesla and NVIDIA continue to be like the most popularly traded, no matter what side. More recently, we've been seeing a trend of, I don't want to say it's meme stocks, but the theme of the dorks that came out a few weeks ago, like Open Door, for example, that started being something that we saw a rise in popularity on our platform. But overarching all that continues to be that our customers really do kind of take core positions and then trade around the volatility. So what that has meant is Eli Lilly, right? Like not a great quarter, ended up being a top buy. Tesla, top sell. It was up like $20 in the last week, or $40, I think, actually, in the last week. So they do tend to do that. I'd say on the crypto side, ETH is starting to be a little more rising popularity, but Ripple has been the most popular over the last few weeks. You're also seeing we have something called the Robinhood Investor Index, and so that tracks kind of ownership over time. And about 20% of the index is in some sort of AI or AI-related names. So you have other overarching themes that our clients tend to be able to invest in a secular trend over time.
Is that low, or is relative to the past?
It used to be lower, I would say, because it used to be a lot more of the Mag 7s and the things that they know and use, like Disney and Apple, and those things used to be at the top, and now you're starting to see those things start to drop and more of this theme coming in. The other theme that I saw come in more recently over the last month is aerospace and defense names are starting. So that's 3% of the index, which is not huge, but it has a little bit of a name in there.
Yeah, and you were just saying how you're seeing more individual stock picking on the platform. There was a big ETF boom right around the April lows from the tariff announcements. So what can you decipher from that? Are retail investors becoming more tactical or really chasing a lot of these momentum opportunities in volatile time periods? I
think they play the volatility really well. I think they're very savvy. Our customers are anyway, generally speaking. And that tells you when there's a big dip, they're just go long beta, right? That's kind of the way maybe a multi-asset class portfolio manager might think. And then once you kind of get to the point where beta, there's more to play in the individual name space, that's where they tend to focus. And you do see it. I mean, the one thing I would say is that there's also a little bit of our customers do also like income, at least a subset of our customers like income. And so playing some of those ETFs that have a focus on income, that has something else that I've started to see more recently.
And a few weeks ago, there was a lot of talk about investor euphoria, whether or not the market was getting too frothy. We saw a lot of short selling, a lot of the meme stock reaction. Has that settled down at this point, or is that just as active as it was a few weeks ago?
We didn't see that so much. I mean, I'd say, meaning that activity has been high and it continues to be high. I haven't seen much of a shift. But I think there's a place where I'm not sure it will turn, because our customers are younger on average, if you think about it. Their average age of 34. That is definitely lower than some of the other platforms. And they can take longer term views and sort of play the volatility. So if there is a big dip, if things start, then they do buy when there is a dip, which I think is different than those that may be a little older and need to start thinking about preserving capital.
And we've been talking to a lot of experts that say retail traders have really been leading the market higher because they've been continuously buying the dip and then sort of dragging along those institutions with them.
Yeah,
so really
and things turn out to not be as bad as they were expected.
Yeah, no, at least not in this current moment. We'll have to wait and see. But Steph, thank you for those insights. And while we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.